Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, June 20th, 2023. It is 10:51 a.m. Eastern Time as I'm starting the video, so we're almost an hour and a half into the trading day. This is the first trading day of the week, of course. That's why you didn't get any update yesterday. I didn't realize on Friday, kept talking about well, I'll talk about that in a second. You didn't hear it in the video, but I was talking about having swing traders having 2 extra days overnight risk in that video, which I apologize. This is this software that I've been using for many years. It was always, I believe, considered the best screen recording software out there. I've spent thousands on it over the years, always taking their updates. Camtasia Studio. They're owned by a company called TechSmith. Anyways, it's been buggy. I always upgrade to the latest version, and when I did that last year, the 2023 or about 6-8 months ago, they stopped the screen draw tools. In other words, this kind of stuff that I do all the time, drawing circles, trend lines. For whatever reason, they figured that they would eliminate that feature, which is ridiculous. Anywho, want to let you know. So I still have to run this older version. Where I'm going, my apologies. I did not know the sound. It just sometimes glitches. You have these settings. I don't change them, and all of a sudden it just decided to toggle off the microphone setting, and it turned on the system settings, which means it'll record like whatever my computer is hearing. Alerts if I play a video. All right, so point being, if you know of a good screen recording software, I'm open to it. I'm all ears. That is very frustrating to spend, a good 30 plus minutes recording a video, especially for you guys, and find out that there's no audio. So my apologies there. Saw that today. Now, let me say this. In that video, I didn't really do anything that I hadn't covered before. It was all updates to everything I've talked about. I was reiterating the sell signals that we got on QQQ and SOXX. Remember, we shorted the semis kind of almost in advance of anticipating a breakdown. I had such a high degree of confidence. I made a comment last week in the comment section that I believe the markets would be down substantially this week. That was in reply to one of the trade ideas that I recently shared, a long trade idea saying, the evidence is pointing to a down week. So what I did in that video was, and you can see that I just went over the levels, and I'm going to do that today. I'm going to update just not all, but most of the trade ideas as far as the major asset classes. Here's what we're going to do in this order: QQQ, SPY, the VIX, the semis, because that's part of the stock market, subsector of tech. I'll brush on the market leading FANG stocks. That's everything I did in that last video that without the audio last week, just kind of looking at those key levels and reiterating. So again, nothing that hadn't been covered previously during that week or even the week before. We have a lot of key uptrend lines, support levels on both the indexes, many of those which have now been taken out, triggering sell signals, with some additional ones that we're still waiting on, as well as in those market-leading FANG stocks. So we'll cover that. Start with the market. Time permitting, I'll do brief updates on the other things, the other asset classes. That's natural gas, crude oil, treasury bonds, gold, euro, US dollar. Now, I got a post out to you today, this morning. Nothing's changed. We'll get to that in a second. So a lot of this will kind of be recapping everything. So starting out here, QQQ. This is the 60-minute chart of QQQ. Let me use my crosshairs. So you can see on Friday, and again, that's what I was covering, we had the 2 p.m. candle was our breakdown candle. And by the end of the day, there's our 3 p.m. candle, meaning that red candle right here where my crosshairs are, finalized, printed at 3, a solid red close. So that was a unmistakable, not a, this first one, yeah, sometimes you dip slightly below. These were all intra-period breaks. That one closed back on the trend line. These closed back above, but that was our first 60-minute close below, followed by a confirming sell signal, and even better at the close. So there was a 4 p.m. close. So, 100% breakdown. Now, sometimes breakdowns don't stick. Sometimes you back test. But what I was saying on Friday, take it for what it's worth. Those are sell signals. And so not only, the only difference, what I said in that video is I was talking about, if you short it, you don't want to go too heavy. If you're risk averse, because you have 2 extra days overnight risk. I said the market will most likely go, could gap up or down, and it gapped down today. They backfilled the gap, but it did gap down. and that would have probably exceeded your stop as a long, and then it went back up. And as I pointed out this morning, and any little kickbacks here, you're on a sell signal. Their objective long entry is like a gap backfill. I don't want to see the trend line back. Obviously, I don't want to see it back tested because I'm short, and I don't want to go underwater. But that's where we had the sell signal and follow through today so far. Nothing big, but we're starting to see volatility expand. So your opportunities, in my opinion, as I said last week, you had the sell signals last week, and in being that they again occurred late on a Friday, made them a bit not suspect at all. Just again, that extra risk that over the weekend, maybe we could have gapped back above here, but we didn't. That's why I'm doing the video. And again, we've had plenty of breakdowns. I've highlighted them before. Breakdown there, it started to get going, and then the dip buyer stepped in and bought the dip. That strategy, and I know some mentioned last week they were cheering because they bought the dip, and then of course it went down lower. Didn't work on Friday, but that strategy, it's kind of like a yogiism. It works until it doesn't work, and so let's see. The technicals clearly indicate that we're probably going a lot lower to at least my minimum targets, and those are my these are still the near-term swing targets. We're still looking at, I drew the arrows for you, probably get a reaction there on each of these levels. And this is where, as a short seller, if you want to, even if you're a longer-term trader, I think the odds are pretty good that we bounce there. However, and this is why I do these videos, I want to go over this with the big fangs. We could blast on through there and get that whole, monopoly, go to jail, don't collect 200, go straight to jail kind of thing where the market just goes on down through there. And what might cause that? And that would be a breakdown of the fangs, not just QQQ, which has already given us a sell signal, but if we start seeing a lot of those market leaders break, again, there's a tremendous amount of hot air in this market. You may believe that, you may choose to argue that. Sure, that's my opinion. There are things to support it, all kinds of sentiment measures and overbought, readings and things like that. But I just wanted to say where I'm going with that is, if you are a short-term swing trader and you took the sell signal on Friday, you're looking at a 6%, almost exactly a 6% gain. Very profitable for a short-term swing trade. Well, if you're a bull and you believe we are in a bull market, that this is a part of a new bull market, this rally, and you're looking to buy dips, well, I've just laid out support levels. That's my job, is identify key levels. I give you my opinion whether we're going to bounce on those levels or ultimately take them out. And so again, I think as of today and right now, even that the odds are good if we get there, we'll bounce. But if and as we get down to that 348 level right there, in the larger uptrend line on QQQ, which is what that is. Whether or not we bounce and how far we bounce will likely depend on how the charts look at that time. So let's not get ahead of ourselves. We're only down 1% on the NASDAQ 100, but it's again, it's not a random pullback. It's a break of this, wedge. And, there was a last wedge break. I thought that could go down, and we grabbed the first support. The dip buyers stepped in and bought. Right now, I don't see really any, decent. This is the best support. My first, support level target there, 357.70. So, what you want to watch for is a change of character in the market. That's what I always say when you're looking for trend changes. A change of character would mean the dip buyers come in with less and less veracity each time you hit one of these support levels. In other words, if this is we're in let's say a new bull market with plenty of room to run, and I've been hearing more and more about that blow off top coming, big blow off top scenario that we're just getting going. There's going to be a big blow off top. If that happens, they should be stepping in with vigor here on the earliest support levels like they did last time. If not, we start taking those out, especially if we take out this primary uptrend line on the 60-minute chart. Then that's showing maybe something has shifted. The supply demand dynamics have shifted for whatever reason, and then you have my next targets. You can see here levels marked about 338.82. All right, so let's move on. So there's QQQ. That's what it looks like. Remember, we still have big negative divergences on the more significant daily time frames, which say that any one of these little seemingly, minor breakdowns on this short-term intraday chart we're looking at, 60-minute chart, that any one of those have the potential to be the start of a much bigger move down. In other words, I still maintain that there's a good chance this is most likely just a bear market rally. It's by many metrics well within the realm of what would be considered, bear market rally, Fibonacci retracements, and everything else. And again, I've spoke to this. A lot of people just can't get their heads around it because they get tied up in percentage gains, and they listen to the media that we're in a new bull market because the S&P went up at 20% as of last week, which is hogwash. It's all relative to the magnitude of the moves in recent years, which have been ginormous due to excessive Fed intervention, easy money policy. So the uptrend, the previous uptrend in these rallies, again, to me, 20% move in the stock market up or down, being a bear market is a very antiquated measure. Things should be relative or proportional to the previous trends and moves. And so I don't have a hard number for you, but I can tell you the last two true bear markets, in my opinion, were both about, the last one was 2007 to 8. That was about a 55+% drop in the S&P and NASDAQ. And then 2000 to 2002, which was about almost an 80 or so percent drop in the NASDAQ and still 50 or so in the S&P. So let's just say, 50%, I think that's safe to say that's a bear market. And then again, we'll look at trend indicators to try to figure out a number for a bull market. Okay, so that's QQQ. As good as QQQ is to trade, it's a great trading vehicle. It's usually, as far as the index goes, typically my preferred proxy. Sometimes I'm overweighted to small caps, and sometimes I might trade the S&P, especially if I think there's going to be a big move in the financials, bullish or bearish, because that's one thing lacking. You have very little, if any, exposure to the financial sector in QQQ. It's primarily a tech index, over 50% tech, that is. So let's talk about that. So with that being said, a lot of people trade the S&P. A lot of people only trade the S&P. And so it does matter, and it's also more indicative of the overall stock market. So last week, in that video I was doing on Friday, I pointed out that we hadn't yet broken down that the QQQ, and I give you my word on this, is only going so far to the upside or downside without the S&P. It had vast outperformance this year to the upside, but you're not going to see QQQ, let's say we're talking that other 30 to 50% next leg down in the bear market I'm talking about. That's not going to happen to QQQ. It's not going to drop 30, 40% plus without the S&P going down at least 20 or so. So you need the S&P. They have many of the top components they share, and it's the stock market. So on Friday, I said, it's a weekend. I wouldn't go home full short until we get a sell signal in the S&P, which we now have today. So that's it. This is a 60-minute chart. That's a very well-defined uptrend line. There are no guarantees. This market's been resilient, shrugging off breakdowns and divergences for a while. But the day that I stop using what's worked for decades for me, again, nothing's 100%. But sometimes you get these kind of overdone, rallies. Same thing on the downside. Sometimes you're going down, down, down. You have these divergent lows. You start to get a buy signal, but they sell into it. And if those divergences continue to build, then it just sets the stage, as it did at the October lows, for a much bigger rally, and that's what we got. So I just wanted to, again, reiterate, as of today, now we have the S&P on a sell signal as well. As I said this morning, any back test, kick back into resistance, whether it's a gap backfill, there's your gap right there. So for example, on the S&P, it might want to go up and not just back test the trend line if we do get a little snapback rally, but it might want to backfill this gap right there. That's from Friday's close to the open today with gap down. What really muddles up the sell signals in the case for that 6% minimum drop that I'm looking for in the NASDAQ 100 would be a solid recovery back above these trend lines. You might still have the divergence, but it would be a false breakdown, and unless we immediately or shortly after fell back down, that's a bullish development. When you have a breakdown followed by a failure of the breakdown, in other words, you get back above what the sell signal was, then that's not good. So as of now, that's not the case. We have sell signals. And so if you missed them this morning, you didn't watch that video Friday because it didn't have audio, or that's where we're at. You could short right now, you could short here, 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 but I wouldn't be shorting here, here, here. And that includes QQQ. I don't want to see SPY get back above there. Doesn't mean that the QQQ trade won't or can't play out. It just means the odds are lower that it will. And the same thing on the 60-minute chart that I had here. You can short a back test. We're pretty far below. That's why at this point, I'm not crazy about it. And if you do see the problem with back testing, I always say trend lines are dynamic, meaning they have a positive or negative slope. And on an uptrend line, it's a positive slope. That means every day, every minute, prices come in at a higher and higher level. So if we back test, it's probably going to be all the way up there. And that may still pan out, and you may get the back test and a rejection. But again, you'll probably take the S&P back above its comparable trend line. So that's it. So you know the levels that I'm looking at. You're going to most likely, if I am correct on it, you'll get more bang for your buck on QQQ versus SPY. You'll also get more bang for your buck on, as I said, on SOX, because it's a higher beta. It is tech. It's more, they tend to go up and down more. And I forget exactly where we shorted it, but there it is. You had the break of the wedge right there last week. Then you took out that first minor support level. What happens when I move around these lines? What a mess. All right, there's S2, S1 was the first. S1 is a trend line. That was your first support level. And then this is what I was highlighting in the video on Friday. If you can see there, that level needed to go. And that went today. So there's where we closed. We had a breakdown, a sell signal on the SOX. It became an official short last week. And then this is kind of that additional sell signal that increases the odds that those targets are going to be hit. And on SOX, if you took that one, if it pans out, then you're talking a 6.7% drop to T1 and T2, which again, this is not mere coincidence that this trend line and this pattern you're looking at in the price action, SOX is very similar to QQQ, except as I just said a second ago, you get more bang for your buck. That's the same trend line, comes off the same lows, mid-October lows, well-defined, also defined by price support, except if you trade SOX, and this is why recommended the downward beta adjustment, you're going to get higher percentage gains. That'd be about a 12.3% profit if that T2 is hit, and it also allows you a little bit wider stops so they don't take you out. They meaning the nefarious market forces, market makers, algos, that go in for the stop rates. They know where all the stops are for those that short it, and that's it. So negative divergence, everything else, and so no update other than the sell signals that I was waiting for on Friday that we didn't get as of the close Friday have now triggered today. But that is a breakdown on SPY to join QQQ, which broke down on Friday, and a breakdown on the semis. So, and you want to get even more bang for your buck than SOX, then that's the old VIX Volatility Index. You can trade futures. That's what I trade usually, or the VIX ETNs. There's a bunch out there. You pick your flavor if you want the leverage and all. You don't need leverage. The VIX is one of the most volatile indexes. It probably is the most volatile index, period. It's like, I don't know, turbocharging a friggin' 12 gauge double-odd buck Magnum shell. You don't need any more juice because of the inherent volatility. Same thing with like UNG, natural gas. You can trade natural gas with an inverse or a positive leverage ETF, but natural gas moves up and down sometimes 10, even 20% in a single day, and then it does it again the next day. So my point is, I would stay away from leverage on the VIX track and ETNs. Big positive. This is just an inverse of the S&P. And again, everything I've gone over in recent weeks, whereas the S&P has big negative divergence spanning for months, the VIX has positive divergence. And the VIX tends to go up when the stock market goes down. And so you have a lot more bang for your buck. If the VIX, and I mentioned that last week too, even to that minimum target right there, first target 15.73, you're talking about a 10% pop. And there's certainly, with these divergences, a potential that this may be a major bottom in the VIX as well. And then you're talking, hundreds of percent return potential, several 100% if the if this is the proves to be the end of the bear market rally, and we're going to stock market drops another 30, 20, 30, 40% plus. Okay, so those are the things I like, regarding shorting the market. And remember, the VIX, being long the VIX is basically to be short the stock market for the most part. So keep that in mind with your position sizing. You are not diversified if you are short the NASDAQ 100, short the small caps, short S&P 500, or short the semis, let's say, and then long VIX. You might have 7, 5, 6, 7 positions there. They're all the same. They're all positively correlated. Then you can do that. You're diversified. Just carve out how much short exposure do I want to the broad, major stock indexes, and lump that VIX in that trade, because that's part of it. And then beta adjust your VIX position size down. You don't take, if your position's 100,000 that you put into SPY or QQQ, you don't put 100,000 in the VIX. You put quite a bit less, because it's going to pay off more. It's either you're going to go up a lot more in percentage terms and the stock market drops, or as far as trying to stay in the game and not get stopped out, you need to allow yourself a wider stop loss. So that's what that beta adjusting your position size does. All right, moving on. Let's see what I have here next. Talk quickly about the market leaders. Like I said, we've seen some, and I've pointed them out, some sell signals on the semis and the NASDAQ 100. And even the SPY in recent months, and they proved to be, they worked, but for much smaller pullbacks than I expected, and then we went higher. Is that going to happen again? Well, it will, unless these break down, and that's the market leaders. This is what it's all about. There's a you call it what you want. I'm going to call it a tech bubble. It's not as big as the dot-com bubble in 2000, but I think the tech stocks are overdone, overhyped, and overvalued, and overbought. That's actually not an opinion. That's fact. Big negative divergence. It tells me that if and when Apple breaks this trend line. So this is what we need to see happen. QQQ is only going so far. In other words, we'll probably only get that 6% pullback I'm talking about. That's possible if QQQ, so let's see here. If QQQ comes down, Apple, it hits that purple, my secondary trend line, that's about a 2.5% drop. Maybe it goes a little lower and then spikes back above there. But for QQQ to take out that uptrend line, that 6% or so uptrend line below current levels that I'm targeting, I want to see, and we will need to see Apple break down, because that's another promise I make. Apple will not stay at these levels or go higher if QQQ is going to drop 20, 30, 40% plus in the coming months. You're going to have to see Apple go down with it. So that's what we need to see happen. And this is where, again, personally, if I see the majority of these fangs breaking down, this is what I've been talking about for the last week or two here, that's where I go to an even more aggressive swing, or it also helps me decide, do I want to extend the targets and maybe not cover a short when the trend line's hit on QQQ and then T2 is hit on SOX? Do I want to extend and maybe hold on to at least some of that trade for a longer term swing or trend trade, or get back into it again after a bounce, then expecting a breakdown? So those are the levels. That's a big one to me, guys. That's Apple right here. And there it is. You have that, and then the secondary. They come in together. They're right next to each other. And we're still above trend there. Okay, next up. Sorry, I had a phone call there I had to take. Microsoft. Microsoft, I've been saying for a while, the trend line's a bit forced. So I'm not super crazy about it, but it is below it. It had a couple of violations, backtest. Still have, divergences, negative divergences, overbought, extreme overbought conditions. The last time Microsoft was this overbought, we have to go back here. I'll put the line right here. Take a trend line, horizontal line, put it where we recently peaked out. We're about 72 here. You can see it on the RSI. There's my extreme, but in a bear market, this is so far. Let me just say this: that we were this overbought right there, about 73, a little over that. Go back, and the last time we were that overbought was right here, when that white line comes in, right where my crosshairs are. That was literally the day before Microsoft put in its all-time high. It's never exceeded that level. That was the beginning. The day after that, the stock put in a bearish engulfing candlestick. Hopefully you can see it in the video. It's right here. That's a big fat bearish engulfing candlestick, and that sucker worked. That's why I like to look for bullish and bearish engulfings. They don't all work. That one marked the beginning of a 39% drop in Microsoft that went into the November lows. So, and we basically just made a double top test of that major reaction high, the bear market high. So and so far, pretty hard rejection off there. So that's Microsoft again. But just recently, for the first time in well over a year, reached overbought conditions not seen since the bear market started. Alphabet. That's level again. All stuff I've been talking about right here. That I keep talking about it without a number being there. I'm going to put the number. I covered it last week. It's about 121 or so. Big consolidation range, negative divergence. If that level goes, and I think I already have an alert, probably have 3 alerts now if I do this every time I do the video, but it can't hurt. That's what I need to go. So if I see the Apple trend line go, the Alphabet trend line go, or horizontal support, I'm sorry, in Alphabet. Amazon recently broke. You have this minor uptrend line. I'm going to show it to you on the 60. Not really doing much right now, even up today. But when you look at the 60-minute chart and you zoom in nice and tight, it's a well-defined trend line, numerous reactions, which I'm circling here. These are all your reactions on it. And it broke down. It's back testing. It's kind of holding up right now. So what you want to see is it start to move away impulsively, and that'll be a check mark for Amazon. It is a breakdown, so I'm going to give it a check mark, but it's more of a questionable one because so far it broke down. It's just kind of hovering right here in a pretty tight range. And so if and when, I'll tell you the number, if you want a number that'll probably bring in the selling because the stops are probably set right below that candle right there. That's the 10 a.m. candle from today. The low on that candle is 124.50, so that would probably do the trick. We'll see if it is. Nvidia, same thing. 375 needs to take out the bottom of that range. Negative divergence says it probably will, but it's far from it right now. It's not even close to triggering a sell signal right now. Tesla, you have to zoom down to the 60-minute chart to see that trend line a little bit better. And it's really just hugging it. You can see it's a pretty well defined. You've got the divergences that have been building since last week right here. These are your negative divergences. You can see the divergence lines on the indicators down here, down below. And that one's just really flirting with that trend line. There's your uptrend line right there. You had that one little whipsaw, and I think that was a gap down that actually bought it right back up. Yeah, they bought it up and closed right back above it. And then we've been flirting with that trend line since. So not a clear breakdown, more of a skirting, dancing on the trend line. So what you want to see for Tesla is and then Meta's still an official trade setup. Beautiful trend line. I mean, just beautiful because it's so well defined. So super long and extended, comes off the early November lows, lots of reactions, clean, distinct reactions, dancing on it. So if and when that goes, and from the looks of this chart, it's going to go soon, in my opinion. And from the scope of the divergences and how well defined this trend line is, how overbought this stock is. Here's another one. Last time we were overbought. I don't even know if there is a comparison here. Let me put back here where it levels nosebleed 83, just like Microsoft, was way back here. So even when the stock peaked right there, we weren't even that overbought. But just like then, we were coming off negative divergence. We had a divergent high at the top. From that divergent high, Meta fell 77%. From the look of this wedge, the divergence, and if I'm correct, we're in a bear market with more downside to come. You'll see another 70+% in my opinion on this one. So that's where, this is again an official trade pending a break of this, solid break and or daily close. When I say and or, the and part means you can, take a partial position on an intraday break and then add to it on a daily close. The or part means if you're Randy, you keep trying to short this rally and you want to have it play it safe, then wait for a solid close below. The downside to that is there's a lot of hot air, and I suspect on maybe not necessarily a Meta, but possibly when it comes, when the dam breaks, when all these lines start breaking, it's going to be one of those 3+% down days in the NASDAQ, which means 5, 6, 7% drop maybe in something like Meta. And so you might, by the time you have that, you wait for a daily close, we could be halfway down towards T1. And then it gets a little less objective. You're in what I call no man's land. No man's land is a term I made up when a stock is halfway or roughly smack between support and resistance. And I call it no man's land because it's like tennis. You don't play the middle of the court. You either play, if you're playing singles, you either play back on the court where you're supposed to play, or you charge a net. You don't play in the middle of the court. They're just going to either lob the ball over your head and probably do that, and you're not going to be able to run back and get it, or they'll do a little lob shot right down onto the net up front. And so no man's land is the same way. You don't enter a trade smack between support and resistance, because if you do, sometimes you get that big breakdown. Well, then right away you may go on and back test, and then immediately you're underwater on your short. So I like to short as close as possible to a breakdown below support or a back test of support, which once broken, which is resistance. And so that's why, that's the downside sometimes when the charts are really set up for a potentially sharp move. If you wait for those solid signals or evidence, that, hey, the trend has changed. I mean, if you wait for evidence of a trend change, all those singing the bull song right now that we're in a new bull market, and you wait for them to start recanting that, and so maybe it was we're gonna be down here. You're gonna be halfway down. You're gonna be 45% below. We start backfilling this gap. That's when they're gonna come out on CNBC and start marching out the bears. And the bulls will go back. So I just want to say that sometimes you got to get ahead of things, and that's my trading style. I like to catch the turns in the market or in a stock. I don't like what I call trend chasing. Trend chasing, it works great till it stops working. That's people buying this, but those folks weren't here. I was long here on Meta, Apple, Amazon, everything else at the lows, and again in the beginning of the year. Trend chasers, well, we were in a downtrend. So when to them did it become an uptrend? So those are the folks that started buying here recently, and that works for a little while here. And then by the time they realize they're going to be dip buying, because their belief is that we're in a bull trend, bull market, and so they're going to be buying T1. And they'll probably get a bounce, they'll get happy. But then when T1 breaks, they'll buy T2, buy T3. And at some point, they're going to realize that they're, buying at lower and lower prices, and then they're going to give up. So that's why, again, to me, I'll buy continuation pattern breakouts and things like that. But I don't buy when I start seeing big divergences and all that. And that's been for a little while now. I've been looking to, start catch the next turn for the next downtrend versus trying to jump on the bull party right now with extreme overbought conditions and negative divergences and rallies into resistance. You got a massive gap right here. There was a close there. Next day Meta opened up here, so that's a big old gap. There's a reaction about in the middle of it there, and that's what we just hit. That's exactly where so far Meta has rallied into the low right before that gap. Okay, let's just keep it one video today, and then I'll cover the other trade ideas. Natural gas, we hit our first price target. Remember last week I gave you targets on the 60 and daily. They may not line up exactly. This is more of a trend or swing trader. We hit T1, which is a 718. Big divergence. So I still expect in the coming weeks to months more upside. Just near term, we hit T1 as well. On the 60, I gave you these targets here: 721, 8079, 997, 1101, 14-ish. Well, that's not yet extended. I'll make that official. Right now, this is the current final target. But we hit T1, and we did so with some divergence. Actually, you see it better on the futures. Hold on one sec. Yeah, right here. This is my 60-minute chart of NG, the July contract natural gas futures. Divergent low, bullish, downtrend line, breakout right here. Uptrend, zigzag, zigzag, boom. But then here, just recently, we started putting in this divergence, so nothing goes up forever. And here it is. I measured it. It's 26. This is 26% rally off that divergent low, just at the beginning of the month. That was in June, beginning of June, right there. So certainly, a little hot air needs to come out. Negative divergence, and where to? Hard to say. The daily's pretty strong. They may step in here at that reaction. That may be all we get. I would tell you, between there and right here, this would be the re-entry zone or add-on zone if you're just scaling in, want to buy pullbacks. Worst case scenario, no guarantees, but this is where you want to stop out. You have an uptrend line off the recent lows and price support right about there. So that would be my most likely pullback zone for anywhere from where we're at now down to there, and then worst case right here, and anything above, probably stop out if you were in here off the lows and you didn't take profit recently at T1. ZN, I threw this one out to you today for both a technical, for two reasons that Treasuries may rally near term. My targets are pretty shallow. This is the current sold target, and it's not much, but I don't have to tell you this. If you trade futures, they're highly leveraged. You know where to put your position size, and I also gave you a beta adjustment for IEF, which is the ETF version of the 10-year Treasury, and so that's a minimum target, very likely target, and good for a Treasury bond trade. You can get, Treasury traders aren't looking for 12 or 30-40% moves like they are in Bitcoin or something. They're looking for get a point or two, and that's better than 1% there. And most likely I'll extend. I think we can work our way up to these targets here based on that divergence. But first things first. So it did fire a buy signal. You can see it's above it, and then IEF. And right now I just have a little better feeling on the 10-year than the better read on the charts too than the 30-year. 30-year, you get more bang for your buck. If interest rates drop, the 30-year bond tends to go up more than the 10-year, which goes up more than the 5-year, et cetera, et cetera. And it's a simple thing here, really. It's not rocket science. Wash, rinse, repeat. Look for these divergent highs, correction, and look for trendline breaks. Not necessarily a divergent low, but we had a trendline break, rally, divergent high, correction, divergent low, rally, divergent high, correction. Actually, that divergent high, I think I had it drawn this way. Yeah, I did. On the chart I gave you this morning was really we did a marginal new high from there to there, so that was bigger divergence. So divergent high 1, correction, slightly higher, divergent high 2, bigger drop, and now we have positive divergence, and we have a little wedge and a breakout. So there it is for targets. So, and it's a way to diversify. And I give you, roughly 2.0 to 3.0 beta adjusted position size. So what does that mean? So you go to the little calculator icon here, and the entry point on that IEF was 97. The target's around 98. So let's say again, you normally do your numbers 10,000. You do a beta adjustment of 3. So now you put 30,000 in IEF. It's a long trade. Your entry price is 97, as I said. The target was right about 98. And your stop would be, if you're targeting 1 point, you might want to stop of about 96. Let's just say 96.50 for the sake of this example. Your risk rewards 2.0. You're going to buy 300 shares. 2 to 1. I'm sorry. Risk reward ratio of 2 to 1. You're going to make 1% of hit, but that's going to give you $300. So you're taking, again, you're risking $155. So again, if you had a SPY trade and you put 10,000 on a swing trader, an active swing trader would be happy to get 3% on SPY. So that's the beta. But SPY, you would only put 10,000, but you would have made the same $300, right? So it's all in dollar terms. Because again, you're not you don't go broke by or make a lot of money by making or losing, and you don't calculate in percentage terms. What I'm trying to say, it's all about the dollars. So you want to make worth your while. You want to make, again, I'm just using round numbers. You plug in whatever number, whether you're $1,000 or $1,000,000 per trade. You can plug that in here. It's all about the dollar amount that you're going to make or lose on a trade. So that's how that works, and you can use this one as well. It's a nifty little portfolio position size, and this is like, so let's say, here's another way. You have $100,000 portfolio, and you want to put 20% into the equity QQQ, and as I told you in the beginning of the video, you can lump SPY and VIX and all that into there, and you're going to short it right now. And again, that's for an individual position. But if your entry price is 50, you're targeting a 10% pullback. That's going to be 45, and whatever your stop price is, 53, whatever it is. It kind of will tell you how much you want to put at risk on that particular trade, and again, you can plug in your risk reward ratio and all that good stuff there. All right, last but not least is gold, euro, the US dollar. I talk about all those in pretty much one. They have a much faster. Remember, I showed you last week and many times in the past the very strong correlation between a positive correlation between the euro and the stock market, meaning they go up and down the same. When the euro's rallying, the stock market's rallying, and the euro. The good thing is, there's often been a little bit of a heads up where the euro turns first, bottoms first before the stock market bottoms, and tops first. Not always. Sometimes those turns are concurrent, but they're pretty solid. Again, I've gone over that before. But there's a much more almost direct and very little lag time between gold and silver and all that. So you remember last week, I got it out to you this morning, 101. I gave you my preferred scenario. We shorted gold here on the break of this, rallied down, then we got long for the bounce, got out, and recently I said my preferred scenario is that the bounce will stop here and we'll go on down and probably come on down to this level here, that blue line, maybe a little bit lower. That'd be the measured target, and that's going to put downward pressure on gold. And you can see that today we did get a rejection there. You can see it stopped at cold, and this is why, again, daily chart, all that matters are daily candles. So that day we closed right on that 109,375. This is daily chart. The next day, which was Friday, we closed right on again. Monday, although it was U.S. stock market was closed, Forex still trades. Oh, that's Sunday. Forex is trading, and picks up on Sunday evening, like futures on it, and then boom, finally rejected and rejected again today. It's moving down now away from it, and so especially today. So it is not mere coincidence that gold, likewise, is moving lower. And you can see, go to a 5-minute chart. It's been falling with the euro. So again, very positively correlated. Told you last week that you had this kind of triangle pattern here, and you still have some divergence. So again, you do what you want. I, at the very least, said I got out of my gold and silver longs. Not in those. Don't care to short it because you have this positive divergence. Sometimes gold can catch a flight to safety bid if the market corrects, and so you have the divergence. And you would still have it if we'd moved a little bit lower, but it could get ultimately taken out. So again, my preference is kind of stand aside, but you can, if you're going off the chart of the euro is going to fall quite a bit more. Gold and silver are probably going to continue down. And so, I remain near-term bearish on those. GDX too, of course. I always say GDX is just a leverage play on gold. GDX is down 3.41% today, while gold is down 1%. So there's that ratio I talked about. It's like a 2-3 time normally. So like I said, you can tie up 10, 100,000, whatever your position size is in gold, and make 1% today. Or if you believe that the euro is going to fall and gold was going to fall, you could put that same amount in GDX and make 3 times as much. Or more importantly, use less capital, cut your position size down in half, maybe 2/3, put it in GDX, long or short, and you're going to get, again, it's just a way to free up a little more capital and get the same kind of returns. All right, let's wrap it up there. We're right at just above the 44-minute mark. As always, you can watch these videos on, I like to watch just about all YouTube videos on 1.5 to 1.75 times playback speed. It makes them go by faster, but that's up to you. It depends. I tend to talk fast, read fast, and kind of listen to stuff fast. But I just want to point that out, and that cuts the video time down quite a bit if you're pressed for time watching these. All right, let me get this one out to you. Let's see where we close today. Let's see if these breakdowns stick and get built upon. As of now, like I said, there's no reason not to think they will, because now we have the SPY joining QQQ. But the day is young, and we've seen some plenty of dips get bought up lately. So let's just watch and see how things develop from here. And I'll certainly do an update later today, good or bad. All right, this has been Randy Finney with Right Side of the Chart.